Hello and welcome to True Potential, Do More With Your Money podcast. This is the first post-budget podcast, the first Labour budget in 14 years and the first delivered by a female Chancellor into the House of Commons. So before we get into the detail of what was said yesterday, I'm going to go through the panel and ask each one of them what they think is the key takeaway. And I'll start with you, Chris.
Yeah, hi Mark. I think the key takeaway for me is that it maybe wasn't as bad as what I was expecting. So probably about 6 weeks ago, I was looking at something on the internet in respect of the budget. And then within that, the internet then set stories for you every day. And every single day I got the most depressing stories about what could happen in the budget. And a lot of those depressing stories didn't come true. So for me, probably the biggest takeaway is, although it is what I would describe as quite a harsh budget, it wasn't as bad as maybe what some of the papers, some of the media were coming out with in the stories leading up to that budget overall.
Deliberate leaks, do you think?
I think there's definitely some deliberate leaks. It was interesting. Kevin and I went to see an investment manager probably around about a month ago, and they were saying that that's exactly what they were doing. So they were setting their stall out to be incredibly negative, and then within that coming a little bit more positive than that to make people feel a little bit better about some of the news that came out yesterday.
Yeah, okay. Craig, what about you?
Yeah, I think having spent a lot of my career in pensions, certainly the changes to pensions from the state perspective has been probably one which we didn't see happening. It was certainly rumoured alongside many other changes to pensions, but for them to kind of lead the charge in respect to that was certainly took myself and some others as a bit of a surprise, and definitely changed the way we see products in planning moving forward for a lot of clients. So yeah, important. Yeah,
and unlike some of the announcements from yesterday, at least as a lead into this, the changes of the pension side of it. Not that you want a severe event to be an inheritance tax planning episode, but we'll get into that in a little bit more depth later. Kevin?
So I'm going to be the dour Scotsman here, and my takeaway is we should hope some of the longer term forecasts within the OBR's report are wrong. They actually think come the end of this parliament, the measures announced yesterday will actually start to detract from growth and make it more difficult for the country to generate jobs, which is a bit bizarre given that the whole of yesterday's agenda was to try and promote investment and growth. Yeah. So there is a lot of devil in the detail. The OBR report is very long, it's over 200 pages, but some of their projections are quite damning for what this agenda from Labour will ultimately achieve or could achieve.
Yeah, okay, I understand that. And, just on a business point of view, it's going to affect us at True Potential. And our FD was scratching his head before, and just a rough estimate, it's going to cost us between £1.5 and £2 million a year more, just based on the increases to NI. So yes, we've got to look at the longer term effect. Part of today, though, on the podcast, we look at how it will affect individual clients of True Potential. And for me, looking at it, I couldn't really see any good news, Chris. We've got an increase in CGT. As Craig's mentioned there, we've got a fundamental change in pension law, which will affect a lot of families' tax planning. And you've got things like business property relief, agricultural property relief that we need to consider, and families need to consider going forward. So there's the one good point that I could see coming out of it is the uncertainties come to an end. At least we know where we've got to get to and how we're going to get to it. But Kevin, I want to come back to you because yesterday you and I were in a series of meetings and the market's changed pretty dramatically during the course of the afternoon.
Yes.
Could you run through that for everybody, please?
Markets took the budget itself very well, which was no surprises, a commitment to growth, and the headline measures announced were, as expected, as Chris said, the leaks helped condition that. The real dead weight was when the OBR published the data and the projections that surround that. And what really affected the market was the level of borrowing up front. So big increase in borrowing from next year for 2 years, that some of the proposed revenue raising measures, the tax increases, won't actually raise the taxes that are expected. And the IFS are out today saying that the national insurance revenue raises aren't credible. And the other is that Chancellor Reeves will probably have to come back again in about 2 years to borrow even more. So what we saw going into the budget was gilt yields falling, so the bond market taking it well, willing to charge the government less for borrowing, and then a fairly hefty spike at 230 all the way through yesterday, and that's continued today. So effectively, borrowing costs for the government have got more expensive.
And have we seen this before?
We have seen this before. Now, this is nothing like what happened with Liz Truss, because everything was a surprise. The interesting thing is borrowing costs today are very close to what they were during the worst of the Liz Truss government. Yields on 30-year government bonds are around about 4.75%. That's, very close to what happened with Liz Truss. The issue, I think, for this government is that actually stopped the Liz Truss government from coming into the market to borrow.
Yeah.
I don't think this government will have any choice but to borrow. So they were in today borrowing. They're back in on twice next week, and they will be in 2 or 3 times a week, every week for the next several years. And we're borrowing at a very high interest rate. It's actually now higher than that in the US. And it's at a 25-year record relative to, say, what it is in Germany. So the UK is being charged a lot to borrow.
Yeah, and it's the tax, borrow and spend budget, really, isn't it?
Yes, because there's just the OBR believe it's not going to increase growth. It's a lot of it is going into public services. A lot is going particularly into the NHS up front, and that just doesn't have that sort of growth tailwind that you would expect. For instance, if we were building roads or infrastructure for, say, AI or software companies, etc., it's all traditional tax and spend.
Yeah, of course. Now, if we look at the, say, capital markets, we touch on the gilt side there. What about equity markets? How have they reacted?
Yeah, so equity markets actually, what we saw on the day, you saw the more domestically focused UK equities. They actually were up around about 1.5% on the budget announcement, and then they pared back some of those gains. So they were slightly up on the day. If we look at the bigger companies within the UK index, then we saw they finished up very slightly ahead on the day. So some of the sectors that did particularly well were retailers and also the banks as well. So from an equity perspective, probably on the day, not so much change. Now, obviously, volatility around the announcement. I'd say that maybe some slight relief, that it wasn't maybe as punitive as what some traders were thinking overall, but only very slight relief there. And then from a sterling perspective, what you saw is some sterling strength come through on the announcement. But then again, you saw that pare back as you kind of went through the day overall. Okay.
And one consistent theme we've had, Chris, about political moves in the UK is that it will have limited effect on the portfolio of the multi-asset funds in the portfolios.
Absolutely. It's interesting. I speak to a lot of end clients, and I'd say, then I'm sure you do yourself as well, I'd say over the last probably 3 months, the key question they've had is how will the UK budget affect their investment returns? And it just doesn't really affect them at all. We've seen within moves in assets, the key move has just been the move up in yields in gilts, which obviously Kevin talked about before. But from a global perspective, there's no move there in respect of what's happened in the UK budget.
Okay. Craig, with capital gains tax, is all of the gain on an asset taxed under the CGT regime?
So at present, which is going to be maintained, is you've got a £3,000 personal capital gains tax allowance. For a trust, it's half of that at £1,500. So any gain in excess of that will be subject to the new rates at 24 for a higher rate taxpayer and 18 for a basic rate taxpayer. So there is still allowances in place. It is worth noting those allowances have come down over the last few years, but they are being maintained at the current rates of £3,000 and £1,500 for trust, respectively.
Which makes ISA and pension investment even more tax efficient.
Exactly. Utilise them allowances in the first place, and then we can again look at alternatives within our range of products that are available to our clients.
No, and previous governments as well have done a good job in eroding the benefits of capital gains by cutting the annual allowance to the point where we're going to get down to zero very, very shortly, which kind of lends itself nicely into the other type of products which are available. You know, that we constantly remind clients to invest as much as possible in ISAs and as much as possible in pensions.
Correct. Obviously, within the ISA and still within the pension, you're getting that sheltering from CGT. So hugely beneficial and tax efficient. Even if we disregard the inheritance tax potential problem which is going to arise, they're still massively more tax efficient than the norm. So we'd still encourage clients to use their allowances in relation to pensions and ISAs in the first instance before they then look at alternatives within the proposition.
Okay. Turning now to pensions. I think this was the biggest change that the majority of our clients will see in the way that taxation will be levied on pensions. Craig, I'll continue with you if you wouldn't mind picking that one up, please.
Of course. So at present, one of the main features of a pension, certainly from the taxation side of things, is it doesn't form part of your taxable estate for inheritance tax. What they said yesterday is from 2027, pensions will now be included within your estate. So, for example, let's say you are an individual, a single individual with children. You've got a nil rate band of £500,000, £500,000. So what that looks like is a £325,000 normal nil rate band with an additional £175,000 residential nil rate band, which can only be offset against your primary residence. Previously, your house, your cash, your ISAs, your bonds, whatever you may have would be typically included, but your pensions wouldn't be. From 2027 onwards, they now would. So if we just look at the high level figures, if you take the average house price in the UK, about £289,000, that utilises around 58% of an individual's nil rate band alone. Now you've got to consider that individual will have cash, could even include chattels and cars, pensions now. Very quickly, a lot of individuals who previously wouldn't be affected by inheritance tax are now probably brought into that remit. I think I saw a stat that was between 2027 and 2028, just 1 year, circa 10,000 estates will be affected by inheritance tax, which weren't previously. So it will affect a lot more people than it does currently.
Okay, and to quantify that, then, it's the unused part of the pension which could pass to beneficiaries,
correct,
which has previously been free of inheritance tax. If somebody has money left in the pension at the time they die and pass that unused proportion onto a beneficiary, that will form part of the estate and be taxed
exactly. So
at whatever the rate is.
So
at
just
the time.
whatever you haven't used in your pension. And then another important point to make is even the rules so if you die before age 75, the beneficiary obviously inherits that pension and can draw on it free of tax.
Yeah.
If they die post 75, the beneficiaries get taxed at their marginal rate. So let's say you're a beneficiary, you've received a pension which has incurred a 40% inheritance tax liability. The beneficiary, if the individual dies after age 75, they'll also have to pay income tax on that asset as well. So the levels of taxations which could be levied on a pension now are significant in certain circumstances compared to what they are currently.
To my simple mind, that sounds like double taxation. But I think it's important that we look at it. And one of the biggest scare stories going about pre-budget was the either abolition or putting a cap on tax-free cash that you can take out of the pension. Chris, Kevin, before Craig comes in on this, is there anything you would like to add to that?
Well, I think I'm gonna come back to the OBR's forecast, if that's all right. I just think that there's a lot in here that the market, that your average punter isn't aware. So that, I mean, the OBR now forecast higher inflation as a result of this, and higher mortgage rates.
Yeah.
All as a result of these initiatives. So everybody is affected by inflation, no matter where you are in your working life. And we know that one of the key downfalls for Liz Truss and Kwasi Kwarteng was the shock on the mortgage market. Now, we're not going to see that type of shock again, but just as the UK was getting over that hill with inflation, we just seem to now have now going to face another modest wave of inflation, and it's probably the biggest difficulties for the Bank of England, who are expected to cut interest rates in a couple of weeks. They probably will, but I think they're going to be it's going to be very difficult for them to forecast the degree of rate cuts the market was expecting next year because of this extra spending. So I've gone way off tangent there, Mark.
That's quite all right. That's the joy of a podcast, Kevin. Chris?
Yeah, I mean, I think for me, what do we know? We know that there is a huge savings gap We know that people need to save more into their pensions. We know that people are living longer. All of these things are key factors that the government need to be incredibly aware of. So in some ways, I probably wasn't surprised that they chose not to touch tax-free cash. Maybe I'm with Craig actually a little bit in the fact that maybe I was surprised that they did choose to put pensions into as part of inheritance tax overall. But for me, we should be encouraging people to save as much as possible so that they can have a good retirement.
Yeah, and the message has to be, Craig, don't stop what you were doing, saving into a pension because of this.
Yeah, and what I would say is it's out of all the changes which were rumoured, you mentioned the PCLS or the tax-free cash, the potential cap on tax relief on pension contributions, that hasn't been changed. So in many ways, for the majority of clients who are maybe not higher net worth, this is probably the most popular change that could make to pensions, because at face value, a lot of people aren't affected just by purely looking at it. They're not taking tax-free cash if they're keeping pension relief on contributions the same. And also by doing that, I think they've been quite clever because they haven't affected any allowances. They don't have to offer any transitional protection in place. They don't have to offer anything to protect those who had the previous allowance in place. So again, whilst it came as a surprise, actually for most people, it doesn't impact them on face value.
Okay, and does this only apply to private pensions then? If you've got a public sector pension,
yep.
How does that affect it?
So they're unchanged in that you could not pass a defined benefit or final salary pension onto your beneficiaries. That money would be paid into your estate and then would go through normally. So that wouldn't affect the public sector pensions in the main. The only pot that it does affect is if you have a money purchase or a defined contribution pension. Previously, that could be passed on as a beneficiary pension outside your estate. Now that's obviously no longer the case.
Okay. Those are the two main capital taxes that an individual will be subject to in the UK. What about income tax? Anything really we need to know about?
I think they've used it as a kind of a pseudo benefit of saying, we're going to freeze income tax rates and for a further 2 years. Actually, that's in some ways they've used it as a kind of guise to hide what's going to be additional taxation for a lot of individuals. Obviously, you have the main term they use is fiscal drag, whereby individuals will naturally earn more over time, and we've seen the effect of inflation, but their allowances will remain the same. So ultimately, the amount of tax which they're going to receive over the next 4, 5, 6 years is going to increase as a result of that fiscal drag.
So basically, by not increasing allowances, you're going to collect more tax.
Yeah, and I think if you look at the high level allowance, since 2019, we've received a £70 increase to the personal allowance. So for the best part of a decade, that personal allowance isn't really going to change.
Yeah. And there's also the level of contribution that you can make to ISA and pension is frozen.
Exactly the same as with IHT thresholds. So they've kept they've been clever in how they've done it and almost put a positive political spin on it to say, we're freezing them. But actually the net effect of that to clients is ultimately they'll be worse off. So the majority of people are in a worse position, although it's been spun to be a good thing, the freeze.
Okay. Other taxes, Chris, that our clients will come up against?
Yeah, absolutely. So probably the other one was stamp duty.
Yeah.
So in particular for a second home, so that's going up from 3% to 5%. There's quite a fascinating cover of Private Eye magazine, which is it's a thing on trick or treat, and it's called Trick or Trick. And it's got a picture of Rachel Reeves, and within it goes, when Rachel Reeves comes and knocks on the door of your second home and gives you the bad news. It's worth seeing if you can see it. And also, as well as that, they've changed the stamp duty thresholds as well. So they've reduced that down. So it's gone from 250 to 125,000, whereby you'll have to pay stamp duty. That is different for first-time buyers.
Okay.
But it has come down as well. So it's come down from 425,000 down to 300,000 for first-time buyers overall.
The 5% surcharge, that's in addition to normal rates for people who are buying, say, their principal private residence. So if you're buying a second property, the stamp duty is 5% more than it is on one home.
Yeah, that's it, exactly.
So that's going to raise a lot of money, and whether that's a dampener to the housing market remains to be seen.
Probably will be. Because essentially, if you increase the cost of doing a transaction, transactions typically fall.
I looked at the Dewar Scott
so
confirmation
I think
of that.
I mean, this is we've done this in Scotland actually.
Yeah.
So again, transactions tend to fall.
Yeah.
So
Yeah.
in that effect, Westminster is catching up to what the Scottish government did here a few years ago.
And I think that's an immediate change as well in relation to the stamp duty, overnight change.
Yeah.
So significant if you were looking to, acquire or in the property market or acquire further properties. That's a 2% overnight hit which you're gonna receive. So significant.
No, quite. And when it comes to the spending side of it, Kevin, what's been funded? Yes, we know it's going to go to the NHS. Defence spending going up,
Yep.
et cetera, et cetera.
So defence, I think there's a strong commitment for defence. So I think they're going to get spending up to 2.5% of GDP. So that's I think we're at 2.1 now. So you're looking at somewhere in the region of 15 billion extra going to defence. The other bulk of it is the NHS. And that's just where it's tricky because we know that a number of capital projects were rolled back. For instance, improving the A1 up here near Morpeth, that was effectively cancelled. It's, where's the growth going to come from? That's the difficult thing. If we think about the spending initiatives in the US, the CHIPS and IRA Act, these were designed effectively to onshore manufacturing in the US and build out capacity for future businesses to compete globally onshore in the US. This budget could have done that. It could have done all that borrowing to fund capital building. So building things the government, effectively the people own, but which have a revenue raising capacity. And there was none of that.
No.
I mean, it was quite disappointing, really. So what we're actually reliant on now going ahead is major deregulation of the planning laws such that private capital can come in to build up, mainly housing, obviously, increase the housing stock for the UK. But of course, the cost of doing that has gone up as well with the rise in gilt yield. So it's quite difficult. The vultures are already circling on this, I think. If you read I think the front page of the FT has changed 3 times this morning from quite down to really down to very down. And the BBC has changed as well. So this story is evolving.
Yeah, and it's going to be interesting to see what Sunday papers and this Sunday political shows make of all of this as well, because what we heard about painful decisions, difficult decisions, they've kind of been made, but they've been done in almost a hidden way. That you come out of it, like we were saying, Chris's first impression was, this is not as bad as it could have been, which undoubtedly it's not, but it's not quite as good as it could have been as well, because they're raising money. But the spending of that money is not going to give any real growth to the country. It'll keep us where we are at best.
I mean, you can't argue with the social consequences. No. Should be the NHS, has additional capital to try and reduce waiting lists and obviously improve the balance of services with regards to social care. It's just that ridiculously, Chancellor Reeves has pledged to make the UK the fastest growing economy in the G7. And we're one of the slowest, and this isn't. It's just the way economics work. This isn't going to generate that growth, and the OBR effectively confirmed that. So I think the Sunday programmes are going to be quite difficult for Labour to say that this wasn't just a pure tax grab.
Yeah, and the majority that the government has should see them through this. Yeah. The depth of the vote, as we covered before, is not that great, but there is at least a 4-year period for this to bed in, and we're not going to see a spring budget.
No.
But as you've alluded to before, there's already stories coming out that this will not be enough. This budget will not deliver what's needed.
Yeah, so in order for the Labour government to not force real-term spending cuts on government departments, but at the end of the Parliament, they're going to have to come up with even more money, and that probably means more borrowing. If there is no more taxes that can be raised, so this is definitely not the last spending budget.
No, sure.
Yeah,
no, and. I touched on it before with Chris, that the fact that the UK is an important part of the portfolio investment proposition, but it's by no means the majority of where money's invested. Means that we can plan around this, and we can position ourselves around this so the clients benefit from the growth which we'll see in the rest of the world.
Yeah, absolutely. I mean, if we look at, let's say, our balanced portfolio, which is our most popular portfolio that we have here at True Potential, then if we look at UK equities, so UK company shares, that'd be around about 8% of that portfolio overall. So the key region that is the largest exposure within the portfolios is the US. And there's a really good reason for that. And that's because actually when you look at the number of companies that are listed worldwide, that is the majority of the index overall. Yeah. So in that sense, although the budget affects us all very personally and individually in our own individual balance sheets, when we actually look at how we're invested globally.
Yeah, yeah. And, the bond yield situation, Kevin, it's not all bad. When new money's coming for investment, you're picking up very attractive yields.
Definitely. I mean, and if we think about it, when Liz Truss, when we had the Truss budget, inflation the following month peaked above 10%. If it wasn't for the energy price cap, actual CPI would have been 19%. Inflation last month was 1.9%. So we've got a much different inflation backdrop, and that means the income you're receiving on your bond or fixed income instruments is you're getting a real return of around about 2%, to over 2% there. So it's a much more attractive environment, especially for our clients who are income oriented and wish to benefit from an income profile which is diversified across all both equities and fixed income. And gilts just got a little bit cheaper and more attractive to generate an income from. Yeah, so from an investment perspective, if you want to receive an income, gilts are a bit more attractive today than they were on Tuesday.
Sure. And just coming back to something you said about defence spending, the level of commitment of GDP to defence spending is something that we committed to under the previous government. And it's something that that Donald Trump is very keen that NATO members pay what he believes to be what they're due to remain, or for NATO to remain intact. And that nicely leads into a bigger event that's coming along politically than the UK budget, which is...
So I think all the UK being on the front pages will disappear on Monday. Come Tuesday, there's a new sheriff in town. Yeah. The Betty Markets say it's Donald Trump, and if it's Donald Trump, well then that's the agenda for the next 6 months. And I would be amazed if when it comes, his first visit to Europe isn't dedicated to NATO defence spending and really thumb screws on a number of countries who are nowhere near 2%. This budget in effect protects the UK because we're above that threshold, but it's a particular problem for continental Europe if Donald Trump is elected. And the extreme scenario is some countries may choose to leave the NATO shield because they just don't have the levers to generate that level of revenue to spend on defence. That's the extreme scenario.
Well, as you say, the news of the UK budget will be wiped off the front pages next week, and there'll be a podcast, no doubt, around about
I think Chris will be on it.
Yeah, am I hosting it next week?
You might just be.
Yeah. So enjoy that one, Chris, and from all of us, that's our look at the UK and the UK post-budget. We'd like to hear from you what you think of the budget, a good one for you, a bad one for you, a good one for the country as a whole, or a bad one. We will watch what's happening in the US very, very closely, as this will have an impact on the portfolios. But rest assured that we will act impartially, taking into account all of the information available to us as we position the portfolios for growth, both next week, next year and beyond. So thank you for watching and join us next time.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.